You're here. You're only visible here.
Oh, really?
Yeah.
Better now?
Yeah, now
No?
it's much better.
Yeah, really? It
Yeah.
should be. Oh, wait a minute. I think if I do it that way, it should be even better.
Now we
Is
have you only with stripes.
Oh, that's wonderful.
Yeah.
Well,
Now not anymore.
okay. Can you kind of see me, parts of me? Wonderful. Okay, so my apologies for the technical problem, or let's say, yeah. Anyway, welcome everybody today. It is a great honor to have you all, especially Rinalini Kausapra from the embassy. A warm welcome to you for having you here. Erwin Cedars and his team from EY. The Indian budget has been out already, you know that. So everybody who is savvy in going through it and took maybe 2 weeks to study it itself is probably not here today. But for all the others, this is a very important day or moment in the Indian year to see what the Indian government has, the focus point of the Indian government with respect to many things, and also with respect to foreign investment and doing business for us. So today we have a big and warm thank you to EY and the team with their wonderful experts who have taken the time and will be here today to not only explain you what is here, but also to answer all the questions you might have. We have already received quite a few interesting questions, so they have been studied up front. And it is now my pleasure to introduce Ms. Rinalini Kausapra from the embassy, who will address you and give you some focal points from the embassy's point of view. And after that, Erwin Cedars will take over the moderation of this event. And thank you all very much for being here today. Rinalini, the floor is yours.
Thank you. Thank you so much, Edith. So I'll just share my presentation. Thank you, Edith Nordman, Chairman of NICCT, Mr. Erwin Cedars from EY and the EY team for conducting the session on the Indian Union Budget 2021. And good morning to everyone who's joined. I think we can all agree that it's been a difficult year due to COVID-19, and globally almost all economies have been impacted negatively, and India has been no different. I will be dividing my presentation into 3 parts. Firstly, I'll give an overview of Indo-Dutch engagement so far, including what happened last year in 2020 and the early part of 2021. The second part seeks to give an overview of the state of COVID-19 in India today and some trends in the economic growth forecast seen. And third, I will highlight some broad key elements of the future economic policy trajectory being taken. I don't want to go into too many details of the Indian Union budget since my fellow presenters from EY will also take us through the finer points. So I'll just touch upon the main areas. Now, the slide that I'm showing you is actually from a presentation made by Invest India, India's National Investment Facilitation Agency, which made a presentation on ease of doing business in India earlier this month. And the presentation is available on the Embassy of India Hague website. We can also send you a copy by email if you like, but it highlights some of the main points of our cooperation. And you can see that over a 20-year period from April 2000 to December 2020, the Netherlands was the 4th largest investor into India, comprising 7% of overall investment, with inflows of $36.2 billion over the period. The Netherlands is also India's 3rd largest trading partner in the EU after Germany and Belgium. And Indo-Dutch relations have seen a number of high-level visits, and in 2019, King Willem-Alexander and Queen Maxima visited India with a very large trade delegation, and Netherlands was also India's partner country for the Technology Summit. And I can say that this momentum has been sustained, though in 2020 we could not see any physical visits. We have seen engagements between our 2 countries. The Netherlands was the partner country in 2020 at the Agritech, which was organized by CII. In November 2020, the 2nd Indo-Dutch Center of Excellence in Vegetables and Flowers was inaugurated in Wayanad district, Kerala, in the presence of India's Union Agriculture Minister and Kerala's Chief Minister. We also had the third Indo-Dutch Cybersecurity School, which took place from September 2020 onwards. And the Cybersecurity School is the result of cooperation between the municipality of The Hague and the Indian states of Telangana and Karnataka. The Embassy of the Netherlands signed a statement of intent with India's premier think tank, NICCT and EY, in September 2020 to support decarbonization and energy transition to accommodate cleaner energy as part of the economic and sustainability agenda. And in 2021, early this year in February, a virtual Dutch trade delegation took place, focusing on 3 sectors of food, energy, and water. The virtual trade delegation was led by NICCT, Minister for Foreign Trade and Development, and India's Minister of Commerce and Industry, Minister Piyush Goyal, was also there at the inauguration. We had over 100 Dutch participants and over 300 Indian participants. Last month, Cochin Shipyard, one of India's largest shipbuilders, signed MOUs with Dredging Corporation of India and Royal IHC Holland to make world-class dredgers. The Netherlands was also a partner country at Global Bio India 2021, which was organized by the Department of Biotechnology in the Ministry of Science and Technology India earlier this month. And both countries have been working together during COVID, and we would continue to do so. Now, I'll just share some figures regarding the state of COVID-19 in India today. Till today morning, India had reported 11.78 million positive cases of COVID-19, of which 11.23 million had recovered. So our recovery rate is over 95%. And there are currently a little over 395,000 active cases. The largest vaccination drive in the world is on in India. Until last evening, 52.1 million vaccinations had been administered. Vaccinations had been initially only for healthcare workers, frontline workers, and those above 60 and those with comorbidities. But starting from 1st April 2021, all those above 45 years of age can register for the vaccine. 2 vaccines are in use in India, the Covaxin and the Covishield. Covaxin is manufactured by Bharat Biotech, and Covishield is made by the Serum Institute of India. India is manufacturing both its own vaccines and also for the world. Now, the government of India took immediate steps to contain the spread of COVID-19 in the early stages by instituting a stringent lockdown in March 2020. Subsequently, as a result of the lockdown, Q1 of financial year 2021, the Indian economy saw a contraction of 23.9%. Subsequently, the lockdown has been eased in stages and economic growth has improved. Overall, the International Monetary Fund has forecast that the Indian economy will contract by 8% in financial year 2020. A V-shaped recovery is foreseen. The IMF has forecast that India will grow by 11.5% in 2021. OECD has forecast even higher at 12.6%. With one of the biggest markets in the world and skilled labor force, there's tremendous opportunity. The government of India's immediate aim post-COVID was to ensure that people had enough to survive due to loss of livelihoods. One of the first schemes announced was the Pradhan Mantri Garib Kalyan Yojana, which provided free food grain for 800 million people, free cooking gas for 80 million families, and direct cash transfers to 400 million people, including farmers, women, and the elderly. Subsequently, the Atmanirbhar Bharat package has been announced in May 2020 with the aim to promote a self-reliant India. This also points to India being committed to a global supply chain. India has implemented several reforms to facilitate ease of doing business and create a conducive environment for business and investments, with changes taking place in various areas, including labor law reforms and tax administration reform. Production-linked incentive schemes have been announced in many sectors, such as large-scale electronics manufacturing, telecom, and medical devices. And India aims to continue to proceed towards being a $5 trillion economy by 2024. A special economic and comprehensive package was announced amounting to $265 billion equivalent to 10% of India's GDP as part of the Atmanirbhar package. The budget proposals of 2021, which we'll be discussing today, carry forward on the Atmanirbhar Bharat package and rest on 6 pillars: health and well-being, physical and financial, capital and infrastructure, inclusive development for aspirational India, reinvigorating human capital, promoting innovation and R&D, and minimum government and maximum governance. Some key areas of the budget 2021, which I can highlight, because we'll also be going into finer details with the presentations with the EY. But first and foremost, healthcare is a very important area that the budget is looking at. A new scheme is being launched to develop the healthcare capacities of the primary, secondary, and tertiary care systems. Approximately $8.8 billion will be dedicated to this over the next 6 years. For ensuring universal water supply in the urban areas, the Jal Jeevan Mission Urban is being launched with $39.5 billion over 5 years allocated. Additional funds have also been laid aside for COVID-19 vaccines. Funds have also been allocated to complete wastewater treatment and introducing efficiencies in waste disposal. The budget has stated that there will be production-linked incentive schemes for 13 sectors. The insurance sector is also opening up further. Foreign direct investment in the insurance sector is to be hiked to 74% from the existing 49% limit. The IPO of a major insurance company, LIC, is being planned. The insurance market in India is expected to grow to $250 billion by 2025, representing a huge opportunity. Overall, the trend is to move to more strategic disinvestment. In the budget, it was also announced that privatization of 2 public sector banks and 1 general insurance company would take place in 2021-22. Major ports in India will be moving to a public-private partnership model for management. 7 projects worth $274 million are planned. Marine companies in the Netherlands can also view these opportunities, including India's coastal development plans. Within agriculture, the government has introduced many measures, including enhancing agricultural credit and increased contribution to rural infrastructure development funds. Within renewable energy, the Indian government will be launching a comprehensive national hydrogen mission to be implemented next year to generate hydrogen from green power sources. The Indian government remains committed to the ease of doing business. I thank the organizers for giving me this opportunity to share some insights and look forward to the presentations of EY. I encourage everyone to reach out to the embassy in case you have any queries, and also if you'd like to connect to Invest India to learn more. Thank you.
All right, now it's my time to take over. Good morning, all. My name is Erwin Sieders. I'm a partner with EY Tax here based in the Netherlands, but I'm also a member of the board of NICCT, and I welcome you all on this event. First of all, thank you, Miriani Kausapra, for your interesting contribution on behalf of the embassy. Always good to hear the embassy perspective on these matters, and very interesting to hear how India is dealing with COVID-19 and approach on vaccination. I think we can all learn from that here in the Netherlands as well. Also, thank you, Edith, for your opening speech. I would say drive safely and have a good journey wherever you're going. As mentioned, as most recent member of the NICCT board, I'm very pleased to welcome here on our second India budget update by EY, together with my colleagues from India, the Indian desk in London, Amit Jain and Ronak Sethi. As mentioned earlier, the Netherlands is one of the largest investors in India, and the Netherlands is one of the largest destination of foreign investment by Indian companies. At EY, we've seen an uptick in transactions and investments between India and the Netherlands. One of the reasons is obviously the change in tax treaty with Mauritius and Singapore, but I think more importantly, it is the increase in import and export between the countries and the ability of both nations to look beyond their own borders for growth opportunities. I think people expect that by 2025, the bilateral trade will touch around 15 and 20 billion euros, notwithstanding the impact of COVID-19. So that's everyone on the Netherlands-India business. So I think whatever policy changes and tax measures are announced in the annual India budget, it will most likely have implications and is of relevance for the Netherlands-India business community. I'm therefore excited for kicking off the main part of our event, and that's the presentation and discussions on the recent India budget for 2021 and certain other recent and relevant developments by my colleagues Amit and Rona. I'm sure it's going to be a very interesting session with room for questions at the back during our Q&A session. So please send your questions to us via Teams. Now, without further ado, I would like to hand over to my colleagues Amit and Ronak for their part of the event, and I thank you all for your participation.
Thank you so much, Erwin, and a big thank you to NICT and Embassy to partner on this event, and I'm very excited to be here. Let's jump straight into the discussion, and what we wanted to start with is a bit of backdrop and kind of picking up with what the presentation Ms. Mrinalini made on the Embassy side. Of course, 2020 was an interesting year with COVID and lockdown. And the government did really use that period to ramp up a few things. The Atmanirbhar Bharat, the program, which is really to make India part of the global supply chain and leverage on some of the opportunities that got thrown because of COVID, and the need for having a more sustainable supply chain, having a more diverse supply chain, etc. And there were a host of incentives introduced. Production-linked incentives under the production-linked incentives program, and we'll speak a bit about it. Really to, incentivize foreign companies to make in India to cater to local market, but also to export, in that region. Interestingly, we are already seeing, starting from the last quarter of calendar year 2020, and even the first quarter of the current year. A lot of Indian companies have bounced back. As we see globally, even in India, the stock markets are higher than the scale at it was pre-COVID. So there is a lot of already a recovery which is happening. There are estimations of almost double-digit growth in the fiscal year 2021, 2022, and that would continue. So India would kind of be one of the highest growth economies going forward. One of the important kind of decision as government was going into the budget exercise was really, this government has been very, very strict on the fiscal side and wanted to maintain a very, very disciplined fiscal deficit. And I think the need of the hour was really to, provide more stimulus to the economy and probably for the near future be a bit more relaxed on fiscal deficit. And that was also the observation in the economic survey, which was presented just before the budget. If you move on to the next slide, so the government did kind of open up its coffers and was far more pragmatic in its approach to say that let's fiscal deficit targets slip a bit in the next 2 or 3 years, because really the need of the hour is to provide stimulus to the economy, and then with the growth in the economy and with the higher taxpayer base, etc., we would recover that by 2024, 2025. So as you would see that for 2021, the fiscal deficit would be 9.5%, and 2021, 2022, it will be 6.8%, and then starting to taper back to 4.5% from 2025, 26, which again is no different when you look at most global economies. Now, one interesting part which I would like to mention here is that the government debt to GDP ratio in India is still pretty reasonable at about 87% when you compare to average of almost 123% with other developed countries and some countries even 200%, etc. So that shows you enough confidence that the fiscal situation is fairly disciplined. On the capital expenditure side, that's where the government has given the maximum impetus to significantly hike, and this is all investments in various capital projects, etc. So almost a 75 billion increase there. There is an expectation that tax collections will increase in 21-22. Of course, it's been pretty tepid, and I think we're already seeing some offshoots with the VAT collections, our goods and service tax in India. So that really shows that things have picked up both on manufacturing and sales side. On the divestment side, as it was mentioned in the earlier presentation, there's a fairly ambitious target of 24 billion. And then, of course, there is IPO of Life Insurance Corporation, our largest public sector insurance company, but also a lot of interesting opportunities on privatization as well as giving opportunity to multinationals and private companies to operate and manage a lot of government or PSU assets. And we'll talk a bit about more because that is a very interesting area. If you look at the policy investments, it was mentioned about insurance, which was a long ask where the foreign direct investment cap has been increased to 74%. So you could now have a majority ownership really. Gift City, which is one of these cities where the International Finance Service Center has been set up, has also announced to introduce a fintech hub, and that is quite interesting from a Netherlands India corridor perspective, as we see quite a few tech startups here, and there could be interesting opportunity to look at partnerships there. There is also a plan to recapitalize public sector banks, given some of the NPAs or non-performing assets which are developed, which will also free up capacity for banks to then give onward lending. There is also a proposal to set up a bad bank, if I can use that term, to kind of spin off the NPAs or the non-performing assets primarily from public sector banks, and government will initially fund that, but their plan is also to allow private investors and multinational investors to invest in this bad bank, the units that are issued by them. On the automotive sector side, there's a policy to be introduced, and then there's a draft which has got circulated on vehicle scrapping, which will again open up more opportunities. As some of you might know, the per every 100 people number of vehicle is in India is still pretty low, and there's a huge capacity and opportunity there. And of course, there is a focus more towards moving towards electric vehicle, and there's a plan both from the government side and private side to do that over a period of time. So again, opportunity there on whether it's battery manufacturing, which again is likely to be one of the areas within our incentive schemes to allow incentives on battery manufacturing, as well as battery stations, charging stations, various other electronic components, etc. There will be a huge opportunity there. On agriculture, again, in the earlier presentation, there was a fair bit of detail, so I'll skip that. On ease of doing business, there continues to be an impetus to simplify and rationalize, and there is a proposal to simplify our securities laws of combining the 4 securities law which govern various publicly listed and other companies which are subject to such regulations into a simplified code. There has also been a lot of movement towards strengthening the National Company Law Tribunal, which deals with company law matters and mergers, acquisitions, as well as other disputes. There is also a proposal to allow quick resolution of contractual disputes. So that's again a positive step. India has been fairly active on setting up e-courts, and there is again more focus there. Setting up alternate mechanism for debt resolution is one of the proposals in the budget. So again, quite a few impetus on ease of doing business in India, which should also further kind of incentivize multinationals to operate in the country. If you move to the next slide, on the sector side, and I'll start with these 4 sectors, there's a huge opportunity for multinationals to come and explore opportunities, whether it's passively by investing in these sectors or actively by taking up these contracts or providing technology, innovation, infrastructure, which is available. So starting with pharma and life science, and this was mentioned in the earlier presentation as well, India has significantly increased the capital outlay here, almost by 137%, and there is a plan to set up more healthcare centers, preventive centers, more investment on R&D. I believe this is a huge opportunities for quite a few European and Netherlands companies who have that technology innovation to come in and really partner with the government as they look at investing in all these areas, which in India may not have the technology, but there is a huge scale and requirement which throws interesting opportunity. On the retail and consumer side, I think there are two kind of important things to note. One is there is a huge consumer base, right, and which is really expanding both in terms of number of people, but also in terms of disposable income. In the last decade itself, there is almost a double-digit growth and almost doubling of the disposable income by middle income or the mid-income level group, which is quite substantial. On the other side, there is a fair bit of incentives being provided for companies to come and make in India. So there is incentives, whether it's textiles, whether it's electronics, and various sectors. There are almost 11 sectors identified, and there are policies to be issued by those respective industries, ministries over the next coming months or so. But again, huge impetus to come and make in India. And one example that I would like to quote is, about 4 or 5 years back, India used to be the number 5 or number 6 player in mobile handset manufacturing. With incentives and a focused policy, India today is the number 2 player in terms of number of manufacturing companies, that are present. Uh, Again, these kind of throw interesting opportunities for companies which are either looking at focusing on the Indian market and targeting the Indian consumer market to come and target that market and pretty much recover the entire capital cost through these incentives. And I've made a reference only to national incentives. There are incentives by the state governments, and every state government, to be honest, is competing with each other. Right? The well-known kind of secret hint to most companies is that don't tell any state where you're investing, and you might be able to negotiate something very interesting with as you speak to different state ministers on what are the various incentives that they are ready to provide. So on the capital side, you can pretty much recover your entire capital cost, and then you've got a very interesting consumer base in the country to target, whether it's retail and consumer products or whether it's health sciences, to kind of impart or share the technology and earn a royalty income or whatever, or a partnership. So that becomes interesting for a lot of Dutch multinationals. On the infrastructure side, again, there's a fair bit of impetus. This has been a big area for the government for last several years. So there's continuous increase in outlay, as I mentioned, almost 75 billion additional funding is to be done. And there is, also proposal to set up a development finance institution, which will basically monitor all these projects and put up a framework on investments in infrastructure projects, etc. There is also a plan, as I mentioned earlier, of national monetization of public infrastructure assets. And I believe this is quite interesting for, a lot of Dutch companies who have experience in operating, a large public infrastructure, whether it's railways, freight corridors, etc., or highways, to come in and probably, for example, take on lease, such facilities and operate, for that period, and whatever income that you earn belongs to the company, and then you pay your lease rentals to the government. So again, huge opportunity to modernize, to also make the most out of these monetization pipelines. So the divestment is no more limited to just giving out shares or diluting the investment the government has in public companies, but really providing private companies opportunity to operate and manage public infrastructure assets. And one example again I can give here is that if railways in India was a private player, it would have been the most land-rich player in the country. That's the amount of land it has, and there is a plan again to unlock the value in all this land that the railways has today, and which again can throw very interesting opportunities to kind of exploit opportunities coming out of those land, develop various infrastructure, freight corridors, etc., using that. On the financial services side, again, for a lot of passive investors and funds which are set up in Netherlands, there's a huge opportunity, whether it's investment into our infrastructure, investment trust, and real estate investment trust, which are pretty much pass-through vehicles. And as far as dividends are concerned, dividends, you get a complete tax exemption as it flows through a REIT or InvIT, through the domestic law exemptions. There is also specific holidays given to sovereign wealth funds and public pension funds to invest in infrastructure sector. And we'll talk a bit about that as well as we go along. I mentioned about the asset reconstruction company, which is our bad bank. Again, throws interesting opportunities for funds or companies looking at investing in stressed assets. So these are some of the sectors which again throw a lot of opportunity for Dutch companies, to invest in India. If we move on to the specific proposals, on the infrastructure side, there was existing holiday, which was, and I'll cover the pension point in the following slide in a minute. On the infrastructure side, there was a interesting holiday on on setting up affordable housing projects. So that has got extended. So there was a sunset of projects, of getting this tax holiday for projects set up to 2021. That has now got extended to 2022, and it also now includes rental housing projects because the government realized that with COVID and with all the movement of migrating workers, there's a real opportunity to provide low-cost rental housing to these huge kind of kind of group of migrant workers. Again, on the individual side, there's a correlative deduction for individuals who buy these affordable housing projects for 1 more year. As I mentioned on the national monetization policy, both the National Highway Authority, which manages all the highways and roads and infrastructures in the country, and the power grid corporations, both are looking to float a InvIT, where international and domestic investors will be able to invest. Railways is looking to monetize operations and maintenance of freight corridors. Airports are looking at privatizing operation management of airports, and we already have seen two large airports. One is the Munich airport, which is looking at developing an airport in south of India in Mangalore, and then you have Zurich airport, which is looking at developing the airport in Noida, which is north of India. So again, there's already a lot of interest from European companies there. There is also a new scheme to augment public bus transport services, and a lot of funds will be allowed to invest in zero coupon bonds, and this is really to ensure that when you invest in these bonds, what you earn is a capital gains on the redemption or expiry, which means that you may not be subject to any capital gains tax in India because, for example, under India-Netherlands Treaty, such tax and most of the other treaties is not subject to tax in India. So again, there's a significant tax incentive. If you move on to the next slide, and this is the question which was raised on pension funds. So in summary, a sovereign wealth fund and pension fund, meeting certain prescribed conditions and investing in infrastructure projects, whether directly or through a InvIT or a REIT or through a alternate investment fund or through a non-banking financial company or through a holding company, will all be exempt from any tax on capital gains that they earn, on interest income that they earn, and dividend income they earn. So they are really incentivizing sovereign wealth funds and public pension funds to invest in infrastructure, and all income that they earn is completely tax exempt. And this can throw interesting opportunities for large public pension funds in Netherlands, which may have an opportunity to invest in these sectors. So those were some of the macro proposals and large kind of infrastructure related incentives. Let me hand over to Ronak now to take us through some of the other tax proposals. Ronak, over to you.
Thank you, Amit. So if we move on to the next section of the budget proposals, there was certain exciting and stimulating measures which were announced on the International Financial Services Center, which is a specific city set up in Western India with an aim to promote financial services sector. So this has been around for some time, and units which are set up in the IFSC enjoy a host of benefits, including tax holidays for up to 10 years, concessional minimum alternate tax rates, and a bunch of incentives on the indirect tax side. Now, specifically in the budget of 2021, there are proposals to, one, further relax certain conditions around relocation of an offshore fund, which is focused on Indian business or Indian investments. If you move it to from outside of India into the IFSC, there are certain benefits that you would, or tax neutrality that you would achieve when you move the fund onshore. And thereafter, the benefits on disposal of some of the Indian assets, which otherwise non-resident investors would claim under the treaty, would now be available under the local regulation itself. In terms of the impact it has, is that it takes away the subjectivity of claiming a tax treaty benefit, because as you would know, the criteria of beneficial ownership or the beneficial ownership, substance, etc., that has come out from the BEPS action plan of OECD that has also resulted in the Indian tax authorities frequently evaluating or challenging some of the tax treaty claims that have been taken by non-resident investors. So there's a bit of relaxation on this side, and it has an underlying intent of developing the IFSC itself into a world-class financial center. Then specifically to promote the airline industry or the airline leasing industry in India, there's a very big announcement to first allow any royalty payments for aircraft leasing that a unit in IFSC may undertake. So if I give you an example, if there is an aircraft leasing business set up in the IFSC, the business itself is exempt from its profits that it makes from leasing business in India. And very important to note that about 80% of the aircraft fleet in India is operated on a leased basis. So there's a huge, huge market which which this incentive can target. Then specifically when the IFSC unit will make a payment to a non-resident who's the lessor of the aircraft, that royalty itself is also exempt and under the local tax regulation. So again, an intent to take away the subjectivity of claiming any tax treaty benefits on one side, and on the other hand, incentivizing the setup of a local presence for non-residents in India. Then certain safe harbor conditions which are prescribed for a fund manager who was located in IFSC, that has also been relaxed, so which takes away or which further mitigates the risk of any permanent establishment risk which a non-resident fund which would otherwise have in India just because the fund manager was based in India. And then on the startup side, there were certain incentives which are already prescribed for 100% tax holidays for three out of 10 years. That has further been extended for startups incorporated up to March of 2022. And similarly, they are for investors or the entrepreneurs who have some capital gains on disposal of asset for the purpose of investing into the startup. That's also been further provided an exemption. So all in all, an impetus to drive further investments, both non-resident and domestic investment alike, into IFSC and the whole startup ecosystem. If we move on, some procedural relaxations which were announced on the dividend taxation regime. And more so for Dutch companies, there's a very important consideration for dividend distribution, which we'll come to at a later section in the presentation because that's outside of the budget. That was actually announced through the last year's budget, but it still remains very, very important. And one of the better ways to reward shareholders or repatriate cash from profit-making subsidiaries in India. But if I cover briefly the procedural relaxations that have happened, the first one is for FPIs. Essentially, the FPIs are eligible to take a tax treaty benefit on dividend receipts that they have from India, but a specific local regulation had an effect that the withholding tax the payer would levy would be at a higher rate. And that caused a procedural difficulty of cash flow blockage because till the time you file a tax return in India and claim a refund, that would otherwise be stuck in the system, causing cash flow issues. And there was a specific Supreme Court ruling which supported that position. And very important that the government has come out and overturned the Supreme Court ruling through this amendment in favor of the taxpayer, which further displays that there is a focused intent to simplify the taxation laws, and where unintended hardship is being caused due to procedural aspects, those are being done away with systematically. Then specifically on some dividend payments to business trusts, there have been amendments that withholding tax, there is rationalization of withholding tax on that. Then on minimum alternate tax provisions, there were certain relaxations in the local law that a few streams of income are not considered when a minimum alternate tax calculation is made. Dividend was not included already in that list, but that has now been included to remove any hardship. And then there are certain relaxation on advanced tax liabilities because as a recipient, you could never estimate your dividend income until it is declared. And that could have resulted in cause of penal interest if advanced tax payments are not made on time. So there is some rationalization on how you pay advanced tax liabilities on your dividend income. If I move on to the next M&A section, two very, very important amendments or amendments coming in through the proposals. One is on the trade transfer on a going concern basis, which is called as a slum sale in the Indian tax laws. Now, on a reading of the regulations, there was an interpretation that if you would slump exchange a business, not really sell it for a cash consideration, you could take a position that such exchange is not really a taxable event. But if you dispose of a trade for cash consideration, that's a taxable event. And there are certain high court rulings which had supported the view. But now the government has come out and clarified the intent through this amendment, which is basically saying that you, if you dispose your asset in any way, be that exchange, relinquishment, or any other mode, that all those transactions are intended to be covered under slum sale and should be covered, and from 1st of April should be covered under that. So that's a bit of plugging of a loophole that was exploited in the past. And then in recent amendments to the finance bill, further clarifications have been made on what would be the value of such disposal. There's a clarification on the fair market valuation of that trade transfer. Secondly, and here is where a lot of investments already that have happened in the country, as well as certain ongoing transactions are impacted. Now, the Supreme Court, in a specific ruling a few years back, had clarified that a goodwill that is generated, the goodwill intangible that is generated on a business transfer or a reconstruction, etc., coming out from the interpretation of that ruling, would be eligible for a capital allowance or a tax depreciation. Now, basis the ruling, that was also applicable for tax neutral transfers and, of course, available for taxable transfers through a specific provision in the law. But now it's proposed to be amended and said that a goodwill intangible was never intended to be a part of capital allowance block, and therefore any value that's allocated to that shall no more be eligible for this claim. Even for the past claims or the past capital allowance that has been claimed, there are certain regulations or mechanism that has been prescribed in order to recoup those capital allowances that have been claimed. And that essentially throws a bigger question for multinationals who have invested into India, because the capital allowance would have essentially been a part of the whole ETR exercise and the return from the Indian investment, which now sort of goes away. But on the other hand, the other intangibles which a business may have, such as trademarks, brand names, etc., those still continue to be eligible. So now there is a need for a more focused thought of how do you allocate your valuation or a purchase price allocation exercise. How do you allocate the right amount of value to the correct intangible? Because a certain block of intangibles would now not be eligible for depreciation, but a certain block would be, and therefore this exercise becomes important. For the past years, now, of course, this several investments were made with this goodwill capital allowance in mind, and the ETR the doing away of ETR on that also causes significant hardship. So there are a lot of other avenues that could be explored, like approaching a high court with a writ petition, because this is a retrospective disallowance in a sense of what was promised to a taxpayer in the past, or a position that was blessed by the Honorable Supreme Court. So those kind of activities or those kind of alternatives are currently under discussion with a lot of taxpayers who are facing this particular issue in India. And then the last one is for reorganization of public sector companies, but not very relevant for the current group. And so therefore I'll skip to the next one. Moving on to the BEPS measure, from 2016 onwards, India had already introduced the Indian Digital Service Tax, or what's called the equalization levy in the local regulation. And that was one of the recommendations from the Action Plan 1. Now, the 2016 digital service tax was more targeted towards online advertisement and at 6%, which was to be deducted and paid by the resident payer who was making that payment to the non-resident for the advertisement services. But from 1st April 2020, the scope has been fairly broadened. And also because considering the fact that there is no global consensus on how, if and how DST would be levied and what would be the allocation. So India, like several other countries, has gone ahead and introduced its own DST further widened from 1st April 2020, which now has an impact for a large bunch of taxpayers, and with a fairly low threshold limit of $250,000 for a DST to trigger, as against some of the more generous limits that you would see in the European countries. If I can say that The intention while on a global platform was to tax e-commerce operators in the traditional sense, but the way the Indian regulations are worded, those are wide enough to capture even a typical multinational and who would otherwise not be engaged in any conventional e-commerce business. So if I give you an example, if you are a manufacturing group and you have an ERP system which is accessed by several group companies placing purchase orders, sales orders, etc., on using that digital platform or facility, potentially that may also get covered under the DST. And therefore, it's very important to evaluate how the entire supply chain for an online transaction works in your specific facts. Similarly, on payment side, again, there were a few clarifications that came out in the current budget proposals, which basically said that if you accept an order online, place an order online, or if you make a payment using a payment gateway, like um, just to give a name, PayPal or WorldPay, etc., even those kind of transactions could potentially be covered under the DST ambit. So therefore, looking at the fairly large contours of this DST regulation, what becomes very important is your typical businesses which were conducted online, but the goods delivered offline, or vice versa, or the example that I gave about ERP systems, intra-group services delivered online, those should be evaluated whether those are covered under the DST regulations. This would also have an interplay with the regular corporate taxation. So as you're aware, some of these services that a non-resident renders would be taxable in India on a source rule basis as fees for technical service. And that would have an interplay with how EQL is applied. Because in the current proposal, it's been clarified that a FTS characterization, or if the transaction is more akin to royalty, a royalty or FTS characterization would take precedence over EQL. And if FTS and royalty taxation does not trigger, then the transaction is subject to EQL. So some bit of thinking to be done around there. And then lastly, if I just spend a second in the local regulations in the last year's budget, there was a concept of significant economic presence that was introduced in the regulation, which has not been deferred anymore. And that is applicable from 1st of April 2021, which is nothing else but a domestic PE under the local regulations. The scope has been further widened. Uh, while as a non-resident, you would always have access to a tax treaty to the extent that is more beneficial. And all the tax treaties that India has at the moment has a narrower PE clause. And therefore, this significant economic presence would not in practice apply, but it's good to know that it has not been deferred if you're not eligible to claim a treaty benefit. Then moving on dispute resolution, tax certainty, fair bit of relaxations or a thrust towards digitization have been announced. The field audit and the first level appeal proceedings were already moved to an online platform. It's been announced that the second level appellate proceedings would also now be moved online in a gradual format. Anyways, in the COVID times, most of the appellate hearings for the second level body was also happening through video conferencing, etc. And it has only pushed the whole digitization agenda a bit, uh, if I can say so, by a few years, uh, given this uncertainties of 2020. But this was always on the cards and now being accelerated. On authority for advanced rulings, this is a body which to which as a non-resident you could approach and ask for certainty about your tax position coming out from a particular transaction. That is, if you undertake an Indian transaction, whether that would be liable to tax or not, and the related questions. There was a backlog which was happening at the authority because the presiding judges were retired High Court and Supreme Court judges, and therefore, because of their seniority, the ruling or the presiding bench would remain vacant for a long time. So there's a proposal to revamp the entire authority for advanced ruling and rather redefine it by a board which is made up of revenue authorities, which will at least help to clear all these backlogs. And of course, do this on a more real-time basis and not really get you certainty or an answer to your tax question after 12 or 18 months of filing that application. There have been curtailments further to time limit of auditing because India otherwise had a fair re-audit provision, which was basically for which went up to 6 years, which is now proposed to be reduced for 4 years, but 11 years in certain cases where the tax avoidance or the the undisclosed tax exceeds a certain threshold of 5 million rupees. On other measures, there's been a faceless dispute resolution scheme that has been launched, and a tax amnesty scheme, which has been fairly successful in unlocking tax disputes of about $11 billion, has been extended time to time because of COVID uncertainties and also because it received such a favorable response. The last extension, as of the way it stands as of now, is on 31st of March 21. But as of yet, there's no guidance on whether this would be extended further. But this has been a very, very effective platform in closing out appeals and essentially cleaning up your balance sheets of contingent liabilities, or just doing away with costly controversy in India, or where the taxpayer's position was not strong enough on technical grounds. So this has provided a welcome out. Some of the other measures proposals, I'll not spend a lot of time on it because these are fairly procedural. But if you see the theme that's coming out of it, the pillars are: one is simplification of compliances, because there is a thought to pre-fill tax returns and provide it to individual taxpayers, further helping the whole digitization process. Then there are clarifications on MAT provisions where certain money was brought into India or certain adjustments were agreed on account of the advanced pricing agreements that could have had an anomaly on the MAT liability of a particular year. So that's proposed to be rationalized so that there's no unintended hardship. And then, as regards some special audit requirements that are there under the Indian tax regulations, that you need to get your accounts audited by a tax auditor, not a revenue auditor, that's been further relaxed to 100 million threshold. So, like I said, simplification, digitization, and a rationalization of provisions which cause unintended hardship. That's been the theme of these other measures and proposals. On indirect tax measures, again, two key points that are coming out is: one, there is an increased thrust on Make in India, because the customs duty on several components or imports rather have been increased in order to support the local manufacturing. Of course, as a non-resident, if you set up a subsidiary in India and undertake manufacturing operations, you benefit from these measures as well. But for direct selling into India, some of these customs duties make the imports for the Indian importer a bit more costly. And on the GST side, uh, there's a very so what was already being practiced in some shape and form has now been formalized in the law on availment of input tax credits, etc., which is basically that there needs to be a better streamlining of what is reported by your suppliers as your input tax credit and what you're able to claim coming out of it. So the anomalies that otherwise existed in the system, and to some extent certain taxpayers were taking benefit of it, or unintended benefit of it by claiming higher input credits, that's been plugged with this amendment. And those were, in summary, the budget proposals or the select budget proposals from this year's finance bill. And if I move on to two very key developments that have happened outside of the budget, but very important for non-residents, one would be the recent decision of the Indian Supreme Court that was announced earlier this month on software taxability. This issue has been pending in India or before the Supreme Court for was pending for about a decade, and about 100 plus appeals were disposed of in one go by the Supreme Court. And a very major issue that was being discussed and debated at all field audits, appellate forums, high courts of various states has now come to a rest, at least for 4 or 5 main business models when you undertake any kind of these software transactions in India. One is essentially your reselling of software products into India. That is where you are undertaking a distributor function. And the other, which would be more important for this group, is where, as a multinational headquarter, you might secure global licenses. For example, Microsoft licenses for yourself and about 50 other subsidiaries, of which India is a part. And you would recharge the cost of proportionate licenses to India. Now, Indian tax authorities for the longest time had held a position that this payment that an Indian payer makes, either for purchase of software or for allocation of these global license fees, these are royalty in nature and therefore liable to Indian withholding taxes. On the flip side, the tax authorities in other countries or the headquarters home jurisdictions would say that this is not in line with the tax treaty position and therefore not give you a credit of it, therefore resulting into a unintended cost of the business. Now, it's been clarified that as long as there is a limited right of use to the software, the Indian recipient or the Indian user of that software does not get the typical rights of reproduction, disassemble, reverse engineer, etc., that would generally be granted to a person who would exploit a copyright. Unless that is not the case, then the payments would not constitute royalty under the tax treaty. This is a very, very important one because there is a very clear distinction that has been upheld by the Supreme Court between a copyright and a copyrighted article. That when you give a software license to a user for his own personal use or just for distribution, that's a copyrighted article and therefore not subject to royalty taxation. Now, for several of the non-resident companies or their Indian subsidiaries, there would be existing controversy pending before various appellate forums or in field audits, where either tax demands would have been paid because the revenue did not accept this position, or whether tax has been demanded, part of it has been paid, or whether you have paid or whether withholding taxes have been paid, but for the sake of peace of mind, you've not really gone ahead and sought a refund of these taxes so that not to invite any controversy in India. So there would be a bunch of options that are available. One is that you can expedite using the Supreme Court ruling. You can evaluate whether your fact pattern is covered by the rationale of what has been pronounced in this ruling. And if yes, use that to expedite pending appellate matters before various authorities, unlock your cash tax refunds, or where a tax return has been filed but no position has been taken to seek a refund of taxes. Over there, you can potentially go ahead and ask for a rectification of your tax return, subject to that being in the prescribed time limit. For the past tax year, that is FY 1920, that is April 19 to March 20, you still have the option to file a tax return up to 31st of March 2021 and claim a refund of those taxes if otherwise all your logistics are in place. And for the withholding that would have already happened from April 2020 to March of 21, that's a separate financial year, you still have some time to file a refund. So as I mentioned, there, depending on where you are in your audit cycle or your corporate tax filing cycle, there would be a lot of options available, but which would need to be tailored to your specific fact pattern. So that's to take note of. And then if I move to the last one, that is that's the dividend taxation. So from April of 2020, India did away with the conventional or rather the unconventional dividend distribution tax that it levied on Indian companies who distributed dividend. It was at 20.5% paid by the Indian company, and consequently the dividend was exempt for the foreign taxpayer. Now, from 1st April 2020, the dividend distribution tax has been abolished. We've reverted to a classical withholding system under the local regulation or the tax treaty, whichever, of course, is more beneficial to the taxpayer. Now, under the various tax treaties that we have, the withholding rate is generally lower than the local regulation. For the Dutch tax treaty, it's 10% under the treaty, but applying the most favored nation clause, which is there in the India-Netherlands tax treaty, there is a potential to further reduce the 10% tax rate to 5%, and which is all the more important because in the Netherlands, because of participation exemption rules, the withholding tax becomes a cost for you. So if there is a potential to lower the withholding rate, it goes on to save a tax cost. So a lot of because and this is essentially coming for several countries such as Netherlands, France, Sweden, Switzerland, Hungary. All of these tax treaties have a most favored nation clause. So if you have a shareholder from Netherlands or from these other countries holding an Indian subsidiary, you could potentially take a benefit of this 5% concessional withholding rate. and that there are certain measures. If you want to take advanced certainty about this position, there might be certain measures to approach a field officer or a TDS withholding tax officer to at least take a tentative or a preliminary view on this. Or as a taxpayer, you have an option to technically take this position and achieve your cash repatriation. And of course, it's backed by a sound thinking, sound and reasonable thinking. So those were the two developments outside of the budget that we wanted to speak about. And I'll invite Amit if he wanted to add anything on these two key developments, and then hand over after that to Erwin to take questions.
Thank you, Ronak. I think we're all good. So maybe we can move to Erwin, to take any questions or uh, you know clarify any points.
Yeah, thank you, Amit and Ronak, for your very interesting contribution. We did receive quite some questions up front of the presentation already, but I would like to ask the audience or participants whether they have any questions themselves at this stage. So feel free to grab the mic and raise any questions you have.
So Erwin, I see one question on this software Supreme Court ruling.
Yeah.
Whether recharge of purchase software copyrighted article from Dutch headquarter would be subject, to this benefit. Yes, it should not be subject to this withholding tax. In general, now that it's clarified by the Supreme Court, which is a highest court, and therefore any ruling of the Supreme Court is law of the land. That is good enough reason for you to rely on that. I mean, of course, there are some specific aspects that the license is a non-exclusive license. It is for use of the software and not to exploit it commercially, in the sense that you're not giving rights to the source code to rewrite it or edit it or to modify the software. If you meet all those conditions, you should be kind of good enough. So I think maybe a light check on your user license agreement just to be sure that you're meeting those conditions. But a recharge transaction equally should be benefited. And I think it's a great question, because we often see in multinationals that it's not really the third parties who are charging these software use to India, but it's the group companies, principal headquarters, who are probably negotiated a centralized procurement with a again, I'm just throwing a name, Microsoft or whoever, and then they would recharge to their group companies based on usage. So it is a very relevant question, and even those recharges will now be able to benefit with the Supreme Court ruling.
Okay, that's interesting. Maybe as a segue on recharges from the Netherlands to India, are there any recent developments with respect to acceptance of tax deductibility for tax purposes on headquarter cost charges from the Netherlands to India, which is one of the questions that we've received?
Thanks, Erwin. Headquarter charges or management charges, etc., is a fairly debated area in India often, and as we see globally as well. Considering there's always the question whether there are shareholder type activities within that which should not be charged, right? Or what is really the benefit test? Was there duplicative services, etc.? But where you're able to substantiate that these are genuinely services which the Indian entity needs, you can get certainty on that. And we've got numerous, for example, advanced pricing agreements between India and UK, including bilateral APAs, where this has got accepted. Also on the tax side, through because of the India-Netherlands tax treaty, which has a very narrow definition of technical services, you may be able to take a position that these are not liable to withholding tax in India, which could be a 10% cost really. So because of the treaty, you may be able to take that relief. And again, we have numerous private rulings which have been obtained, to confirm this position. So not a straightforward answer, but if you have strong facts, you should be able to defend it. And there are, of course, various court rulings which support, but also you have the opportunity to use these advanced pricing agreements or private rulings to get certainty up front.
Okay, very interesting. not sure whether the audience has any questions right now. Otherwise, I have another one, and that is actually on the last part of your presentation, on the most favored nation clause and the ability to reduce Indian dividend withholding tax from 10% to 5%. What is your experience in that respect?
Right. So this is, of course, very new, right? Because only from April 1, 2020, India has switched to the dividend withholding tax from dividend distribution tax, right? Pretty much from 1997 till 2020, we had a distribution tax except for 1 year where we switched to a withholding tax. So, I mean, it's, technically we believe you should get the 5% withholding based on MFN, which is also the view from OECD as well as the Dutch authorities through their decree, as well as the India-France treaty, which has a similar clause. The French authorities have also mentioned. Having said that, one will need to test it because there is a small technical point that So to explain it, the India-Dutch treaty essentially says that if there is a subsequently negotiated tax treaty with the OECD member country which has a beneficial rate, then I can adopt that rate. Now,
Yep.
India has signed a treaty with some countries which has a lower withholding tax on dividends. The India-Netherlands treaty has a 10% and certain other treaties have a 5%, which was signed subsequently. But they were not OECD member countries when the treaties were signed, and they became OECD member countries later. So there is this small interpretation whether I need to strictly interpret and say that, okay, they were not OECD member countries, I will not give you benefit, or I need to be more liberal. And this issue has to be tested. There is no direct precedent because, as I said, it's only last year since when we started to take this benefit. So, we'll have to see it. But I think the Dutch position is very helpful. And if there are, challenges, one can, of course, approach the Dutch authorities to initiate maybe a MAP proceedings, to try to resolve this issue. But this is something which we will have to test it to be sure that, on the India side also, this view is acceptable.
Okay, that's really interesting. And I guess once the financial year has ended and people are ready to make dividend distribution, then that's the moment to get it tested. I see another question by Chris on the process of initiating advanced pricing ruling.
So advanced pricing agreement or APAs, the process is pretty well laid out. This program started in 2012 and has been fairly successful with almost 350 plus signed APAs. So it's been highly successful. I think the number of APAs India has signed in the 5-6 years is probably what some countries may have signed in 30-40 years of their program, APA program. So you have a detailed application which has to get filed. You would go through your follow-up questions, a site visit, and then a conclusion through a negotiation process. If it's unilateral, it might take whatever 12 to 18 months plus minus a few more months depending how ready you are. And of course, in the recent past, because of COVID, we saw some delays. And if you're going for a bilateral, probably 24 to 30 months. Again, plus or minus depending how accessible you are. But these are, periods at which we have seen APAs getting concluded. And then I think now that you have so many number of APAs, everybody understands the likely resolution which might come for specific transaction services, and they've all been pretty reasonable. If I'm not wrong, Ma'am, Mrs. Mrinali has had some experience with this program, so I'd probably invite her to also add her comments.
Yeah, thank you, Amit. Yes, I was with India's APA program for 3 years and in the field. So we have had a lot of experience with the program. I was there from 2014 to 2017. I can share with you that it is very straightforward. We have 2 APA teams in New Delhi to deal with cases, 1 APA team in Mumbai and 1 APA team in Bangalore. So depending where you are located, you can apply to those teams to look over your international transactions. I would say that concluding an APA, particularly a unilateral APA, will depend a lot on the complexity of the international transaction. So the lesser complex the international transactions, the faster your APA will get concluded. And because we now have a significant amount of APAs that have already been concluded, to that extent, we already know to what extent the range of the agreements will be. So if you have any questions, you can reach out directly to me as well at the embassy, and I can also share more about the APA program.
Wonderful. That's pretty novel, I guess, for most of the Dutch participants, that there is a good link between the embassy and APAs with the Indian tax authorities. But good to know.
There's a question.
Sorry. Yeah.
I was going to pick up another follow-up question. So
Sure.
Just to answer that, the APA takes care of the transfer pricing of the cross-border transaction, right? So let's say there is a recharge or management fee charged by Netherlands to India. What the APA will do is that tell you that from a transfer pricing perspective, this is arm's length. You can go for a unilateral APA or a bilateral. So unilateral, that means you negotiate with the Indian authorities standalone, or bilateral, you negotiate with India and Netherlands. So you're assured that the deduction in India is certain, but also Netherlands is not going to challenge you that you didn't offer the right amount of income, right, to tax in Netherlands. So you get a certainty on both countries. But it's giving you transfer pricing certainty that it's the arm's length charge. On the tax side, if you want certainty that whether it's liable to tax, because the management fee may be liable to tax for the non-resident or based on our source taxation rules, then there's a separate process and authority, which is the advanced ruling authority. And as Ronak mentioned, you could also approach the field officer through a withholding order, which is a separate process, which might need to initiate to get certainty on the withholding tax position. But it's pretty common that many times multinationals go for both the processes in parallel, because they believe one is to get the transfer pricing certainty, but we also want tax withholding certainty. I hope that clarifies your question.
Yeah. Which kind of makes sense. Okay, clear. Excellent. And I have another questions coming in for the embassy. It's more like a general macroeconomic question, and that is whether whether India is able to sustain the growth at the initial forecasted GDP of say 10% in the next 3 years. What's the latest thinking or thought on that?
Well, I think that yes, I would say definitely we will be able to sustain growth rates much higher as well, seeing that the measures that are being taken to improve ease of doing business, as well as the regulatory changes that have taken place. So I definitely do agree that I think not even for the next 3 years, but much longer as well. And India has sustained this kind of growth rates in the past as well. Yeah. So from our side, it's a definite yes.
Okay, that is good to hear. Very exciting. And maybe in line with that, we had another question coming in more like on the regulatory side. Not sure whether you know the answer, but it is whether a foreign bank will get an opportunity to buy a public bank after privatization in India.
Right. So from a tax perspective, if I was to respond, you probably, I mean, and then of course the general trend is to undertake, a lease of a office premise, etc., which you may use for whatever office use, etc., because you would also get tax deductibility on your lease rentals if you purchase the apartment. And of course there are exchange control rules to be looked at. When you purchase the apartment, you might need a local entity to do that transaction. But that will become a capital asset. And if it's a building used or a area used for for your business, then you will get tax depreciation, but at the prescribed rates, etc. Of course, you don't get tax depreciation on land, etc. if there is a land also involved. So generally, what we see is that companies which are just getting started up in India, they probably would use one of these business centers, and there are quite a few business centers like Regus, etc., where you can have a plug and play, and there are other incubation centers where you can get plug and play, and then as you move on, you would do a more established presence, etc. But there's a fair bit of infrastructure in most cities to have a plug and play office, whether it's a single desk, single seat, or a cabin, or a larger space, etc. So there are multiple, commercial real estate commercial players who are providing such plug and play facility.
And maybe moving to the next question.
Yeah, so there is a question how to register a daughter company. So if I understand, your question is how to register a company in India. So I mean, the process has got simplified, and now they have a platform called Spice Plus, where you're able to set up, in the sense, incorporate a company, and also obtain basic tax registrations as a part of the same process, which is fairly simplified. I think practically one area which does take a bit of time is your KYC documents, know your customer. So you would need, let's say, a Dutch company wants to set up a subsidiary in India. You need the Dutch company to give its, company house papers like incorporation document, etc., notarized and councillarized. So sometimes that may take a few days or, time to give, because that is, one of your initial KYC documents. Yeah, equally, your directors would need to take a specific registration. The directors of the Indian proposed for the Indian company would have to take a director's registration, unless of course you decide to outsource that to somebody in India and use a Indian agency to lend you directors, etc. But I think overall the process has become fairly streamlined. Now the only area where we see a few days or time taken is to get these documents notarized and councillarized, because these are initial setup documents, so you do need to ensure.
And how about opening a bank account? Because that's obviously nowadays very difficult in the Netherlands. I see a lot of Indian companies struggling with that. It takes sometimes months to open a bank account in the Netherlands.
Yeah, similar. The practical advice I have is that if you have a banker in overseas which has a branch in India, start with them.
Yeah.
Because please have some records for you on KYC, because I think the key stress point is KYC because of all the immoral, illicit transactions that happen all the time, and the central bank really wants to ensure that the companies setting up at the opening stage, they have clean records, etc. But if you, for example, let's say you have a bank account with HSBC or a Barclays or other banks which have a branch in India, I think the process can be really straightforward. And once you have a bank account in India with HSBC, then to open a bank account with another Indian bank is much, much easier. For example, again, I've just thrown the name HSBC. It could be any other bank with a branch in India. But some of the large banks, multinational banks which have reasonable presence are HSBC, Citibank, Standard Chartered Bank, Barclays on the corporate side, etc. So these are some of the banks which have reasonable amount of presence in India.
Okay, that's a good piece of advice. Thank you. Any more questions from the audience? Happy to receive them.
Yeah, I can also add that one of our public sector banks, Bank of Baroda, have a branch in Brussels. So that might be easier for someone who's looking at opening a bank account.
Yeah.
You can open Bank of Baroda Brussels, and then similarly, Bank of Baroda has many branches all over India.
Okay, that's interesting as well. Thank you. All right. Any more questions? We have a few minutes left. Don't think so, which is fine, because then I think I'm going to give back a couple of minutes to all the participants. Unless, Amit, you have something to add or to conclude?
No, I mean, we are all here, happy to help if there are any follow-up questions, with Erwin and with the embassy as well, to work with you. And there are a lot of exciting changes, and yeah. I think one of the few countries looking to grow at double digit. So there's a lot of opportunity, large population with large amount of disposable income in their hands. So yeah, I mean, we'd be happy to partner with you in this exciting journey.
Excellent. Well, thank you. Then I would like to thank also Mrilani Sapra from the embassy for your very interesting contribution, but obviously also my colleagues Amit and Ronek for their insights. On behalf of EY and NICCT, I would like to thank all participants for joining this event. I think we've learned a lot and know that there are many challenges, but also a lot of opportunities out there between India and the Netherlands. As mentioned, feel free to reach out to us if you have any further questions or require additional information, but also please keep an eye for future NICCT events. I wish you a pleasant day. Goodbye.
Thank you.
Thank you.
Thanks.
Thank you so much. Thank you, Amit. Thank you, Ronak.
Thank you.
Thank
Thank
you,
you,
everyone.
Mrilani.
Thank you, ma'am.
Bye.
Thank you very much.
Thank you. Bye-bye.
Bye, Gopi, sir.
Thank you, Mrinalini. Oh, bye, bye. Iedereen weg. Jij kan er ook uit, Joke. Niemand blijft. Nu
Maar toch?
even kijken. Ik zal even mijn opname stoppen. Opname stoppen.